Welcome to the MySMP.com Introduction to Elliott Wave and Impulse Patterns. My name is Al Hill, and I will be your instructor for this course. Okay, the course content. We're going to focus on 7 primary areas in the course. Number 1, what is Elliott wave theory? At its simplest level, what is the wave theory? There are a lot of various methods out there. Why do people seek to use the wave theory? Does it actually work? Just going to cover some high-level topics. Number 2, why is Elliott wave so controversial? There are a number of Elliottians that constantly put out bearish views. Recently they've been right, but in the last 15 years, maybe even 20 years, depending if you go back to the 87 crash, they've been calling for this sort of, just catastrophe in the world markets. And if you look at the charts, they've been wrong for a number of years. So, in addition to that, there are a lot of different methodologies. So what it really is Elliott wave? Is there really a universal way of looking at it? So we're kind of touch on why it's so controversial. Number 3, what is a wave? Okay, so you hear this very generic, very general term, wave. What does that mean exactly? Is it a short line, long line? Can you have retracements in it? What is a wave? Number 4, how to plot data. Some people plot data from the price low. Some people plot it from, where the actual move begins. So we'll cover that information, exactly how to plot the waves on a chart. And of course, the best for last, we're going to discuss impulse patterns. So wave 1 extensions, wave 3 extensions, and wave 5 extensions. The reason we're going to cover the extensions in this course is because for someone just looking at Elliott wave for the first time, it is the easiest pattern or chart formation to identify because the lines literally jump off of the chart. So, in short, this is what the course is about. So just want to put a disclaimer out there. This course is not for people that are looking to figure out how to predict the market. Quite frankly, it is impossible. This course is not for people that are looking for, a 5-hour course or dissertation on every single type of Elliott wave structure, all the various degrees and every single type of poly wave and multi-wave. Reason being is because a lot of that, especially for newbies, leads to analysis paralysis as well as really preventing the technician from being able to grasp the true understanding and foundation of Elliott wave. So we're going to keep it at its highest level. Impulse waves. These are the easiest ones to identify, as well as it minimizes the number of rules that are applied to impulse patterns. That way it's easier for a trader to memorize and learn the Elliott wave theory. Okay, so what is Elliott wave theory? Well, Elliott wave is named after Ralph Nelson Elliott. He developed this method for charting the world markets. He's also known as R.N. Elliott, as abbreviation, so you'll see that a lot over the internet as well as in books. So Elliott, basically he believed that human beings have a repetitive manner of experiencing life, basically. We all have emotional reactions to things that happen in our lives, and this pattern continues to happen throughout history. So whether you're talking 600 BC or 2009, human beings react to certain events the same way. So he believed that since the market is a representation of people's beliefs, meaning I believe the stock is worth more money, so it should go higher, or I believe the market is overpriced, I believe it should go lower. So the market is the graphical representation of these beliefs, opinions, and emotions. So Elliott believed that by understanding certain movements or price movements, you can actually capture the emotion in the moment of the investors in that particular security or market. And if you can display that data and have rules around that data, you will know how the trade or the investment will work out, because human emotions are repeatable, right? You know, if we're hurt, we react a certain way. If we're excited, we react a certain way. So he believed that this graphical representation would allow an investor to have an edge. So again, when a majority of people have similar feelings, their actions unfold in predictable patterns. Elliot displays that when the crowd shifts from one mood to another, that this can be displayed in his 5-wave pattern. So as you've seen, even today, in the 2008-2009 credit crisis, everyone in the world pretty much feels that, hey, the party's over in real estate. You know, you have to kind of save more. You can't spend and consume as much. And of course, this has led to a reaction in the market. Everyone feels the same way. The market goes down in unison, and it goes down hard. So the thing that makes Elliott Wave unique, it is solely based on price data. Unlike other methodologies which use a number of indicators to look for divergence between the price of the security and the indicator to try to find a turning point, Elliott Wave is solely based on price. And this is because Elliott Wave believes that any indicator, while it may work today, in today's market, it might not work in the market 5 years from now. So Elliott, he specifically, he really understood at a high level, that the market is unique. Each market is unique. So, for example, in our 2008 credit crisis, again, we're in uncharted territory. I mean, things have happened similar to this during the Great Depression, but the market, in terms of being down this long and have this deep of retracement, is unprecedented. So, Elliott Wave is comprised of 5 waves. Waves 1, 3, and 5 are in the direction of the primary trend. So these are going to be your strong waves, right? They're going to actually be the ones carrying the trend. Waves 2 and 4 are your corrective waves. Now, while these waves are smaller in size, they are just as important, because it gives the investor or trader insight into the potential strength or weakness of the following primary wave. So if wave 2 is really shallow, then you're probably going to think, you know what, wave 3 is going to be pretty strong, because wave 2 couldn't retrace a lot of wave 1. Whereas if wave 4 retraces 61.8% or 78.6% of wave 3, odds are wave 5 is going to have a little trouble. So in bull markets, just to kind of sum this up, you have 5 waves up, because although 2 and 4 are corrective, there's still 5 waves going in the primary trend, which is up. And in bear markets, you have 5 waves down, which means that there are 5 waves going in the primary trend of a downward or bearish move.